Hi, this is Jim Pearce, Chief Investment Strategist for Personal Finance, with a weekly update on Friday, September 6, 2024. As the clock counts down to the next meeting of the Federal Open Market Committee in 2 weeks, each new data point regarding the economy is scrutinized for extra meaning. That's why this morning's jobs report for August is getting a lot of attention on Wall Street. Last month, the unemployment rate fell to 4.2%, while the economy added 142,000 net new jobs. So here's that report. I put a link to it in the article. And on the whole, this was pretty much what was expected, but there was some interesting revisions to the previous months. Now, the drop in the unemployment rate from 4.3% in June was welcome news, as was the 3.8% rise in wages over the past 12 months. But analysts were expecting 165,000 net new jobs, so the 142,000 number is disconcerting. Also, the new jobs figures for June and July were revised downward by 61,000 and 25,000, respectively, for those 2 months. At this point, there is no doubt on Wall Street that the FOMC will decrease its policy rate on September 18th. The only question is if that reduction will be a quarter point or a half point. While a half-point cut would be welcome news for consumers with a lot of debt, it would also signal that the labor market is weak. Regardless, the bond market is anticipating total rate reductions of a full percentage point by the end of this year. The yield on the 10-year Treasury note fell to 3.65% this morning, its lowest level in more than a year. Now, so here's the 10-year Treasury note. This is over the past 2 years, so way over here on the right you see this little dot. Now it's up to 3.69. It was at 3.65 a little while ago. But you come all the way across to here and you get to around May or June of last year, and that's the last time it was that low. At the same time, the average 30-year mortgage rate in the United States is also lower now than it's been since May of 2023. So this is from the St. Louis Fed. Here's the mortgage rate over the past 2 years. You can see it over here. For the past week, it's been at 6.35. We come all the way over to May 11th of 2023, when it was also exactly 6.35. That is not only good news for home buyers, it is also good news for the labor market, since the construction industry and businesses that rely on it for much of their revenue would need to staff up to meet demand. That's why I believe the FOMC will reduce its policy rate by a half point when it meets later this month. Now that it appears Wall Street will finally get what it wants from the FOMC in the way of a rate cut, it doesn't seem that happy about it. During the past week, the CBOE Volatility Index, or Fear Index, rose to its highest level since the beginning of last month, when it appeared the economy may be headed into recession. So here's the year-to-date chart of the VIX, and again, all these numbers are skewed by the huge spike a month ago when it looked like perhaps we were heading in for a recession during the second half of this year. In that case, a strong retail sales report for July vanquished those concerns, at least for a while. I'm not sure what it's going to take to get Wall Street feeling good about the overall economy again, but perhaps next week's Consumer Price Index report for August will clarify how big of a rate cut to expect from the FOMC the week after that. From a technical perspective, the S&P 500 index is heading towards a key support level near 5,400. So here's a chart year to date, and you go over here to the far right, you can see, was at the end of August basically, it was up 56.48, and then the past week has been a pretty steep decline. Now, some of you, I realize, don't follow technical indicators, so I apologize if this comes across as gibberish, but this kind of tan shaded area represents from the lower Bollinger Band to the upper Bollinger Band, which is basically represents number of standard deviations from its 50-day moving average. As long as it's within the Bollinger Bands, the theory is that these are really mostly just technical moves, but they don't necessarily signify anything about a new trend. But if it breaks below a lower Bollinger Band or above an upper one, according to that same theory, that could portend either a new correction on the way down or perhaps heading to a new all-time high on the way up. You will notice this Bollinger Band down here is, if we drew a line across, kind of comes across to where it met resistance back in May 4 months ago, but it broke through that resistance to reach a new all-time high last month. But if it falls below this level, and let's just call it 50, maybe more closer to 5,300, If it breaks through the lower Bollinger Band and through this level here, which is also right around 5,300, then it would probably keep dropping until it got about 5,200, which is where you see the big drop last month, and also where there was resistance further back. Even if that happens, even if it falls down to this level here, closer to 5,200, that is only 5% below where it is now, so it would not even count as a correction. September is historically the worst month of the year for the stock market, so I would not read too much into its recent weakness. That's this week's PF video update, and I look forward to talking to you in another week. Thank you.